Hello, clients and friends of Frazier Financial Advisors. We hope your summer is off to a nice start. We wanted to bring you up to speed on some of our thoughts on the current market environment. Before we dive into some specifics in the markets and what we're thinking, I wanted to set the stage with this important chart. The average investor has earned about 3.6% return in the last 20 years, but a common portfolio that's 60% stocks, 40% bonds has earned 7.4%, so about twice that rate of return. And the stock market's been up 9.5%. So the reason for that difference is so important to discuss today with what the markets are doing. A 3% return might sound like not a big difference, but if you compound that over 20 years, you could be looking at hundreds of thousands or even $1 million more of difference from the average investor versus a diversified portfolio. So we're going to dig into why that discrepancy exists. According to multiple studies, including one by Vanguard, a good financial advisor can add about 3% per year of returns for the average investor. And the biggest single component in their research was behavioral coaching. That's really a fancy way of saying helping people make decisions that are correct when times are tough. We all know we should buy low and sell high, but it's so much easier to do the opposite when our emotions get the best of us. So right now, the markets to us look probably in that worried phase. I don't know if we're quite panic-stricken yet, but I would say somewhere around nervous and worried, which is typically a good time to be a buyer, not a seller. Another view was done by BlackRock, one of the largest investment firms in the world. More data on how the average investor tends to buy when things are good, do the opposite when things are bad, and has worse returns than the market. And you've actually been quite well rewarded by buying when things are down, which is probably not surprising that Warren Buffett over the last few weeks has actually bought more stocks than he ever has in his lifetime. So if Warren Buffett is buying, it's probably a good time to be buying as well. One of the main reasons people underperform the markets when times are tough is that they go to cash or they want to sell things and they say they'll get back in when things start to look good. But the problem is the market starts to price in good news incredibly quickly. And good days in the stock market are always clustered next to bad days. And being out of the market for even 10 days over a certain long period of time, even a decade, can really, really hurt your returns. Let's focus on what's going on in the markets right now. The last 5 years have been pretty good for the stock market, even with a big drop due to the coronavirus pandemic in spring of 2020. We were buying when the market was low then, and our investors were rewarded. Right now, we're about a 19% correction from all-time highs in the market, which is a place where we start to get excited about making some buys. Our typical client doesn't just have stocks in their portfolio, they have a lot of things, including real assets, which is real estate, timberland, farmland, bonds. So there's a lot of things going on in a client portfolio. So we have lots of diversification, and only a portion of our client accounts are invested in the stock market. But we'll spend a lot of our time talking about that today because it has been volatile recently. We'll start with a little bit of good news. The bond market behaves a lot differently than the stock market, and bond returns over time are very, very closely related to their yields. So it's very much more predictable in the bond market to know what your rate of return will be over time. And the good news is the bond market has changed a lot this year. Yields have gone up about 2% for every single major bond asset class. And so that part of our portfolio is going to be able to provide a lot more attractive yields going forward. Other things that are good news, diversification has worked in many ways. So we own things like real assets, gold is in a couple of our funds, and we also own some bonds that don't behave like the regular bond market. So all those things have been working for clients. On average, we do get around a 14% decline in the markets, even though the stock market has been positive more than 70% of the calendar years going back the last 70 years. So even though stocks typically are up each calendar year, we do get downturns, and it's pretty common to get about a 14 or 15% correction every year. We're currently around minus 20%, so that's something that happens every 3 or 4 or 5 years. So somewhat of a bigger event, but also not without precedence. The range of outcomes in the stock market in the short term are very broad. You could be up 47% or down almost 40% historically. But if we look at rolling 5-year time periods, the range of outcomes for the stock market starts to really narrow. And even with a much longer time frame, say 20 years, the worst annual return over a 20-year period in the stock market was positive 6% on average each year. So stocks are great long-term investments. And if you're going to earn a 11.5% return since 1950, the reason you're able to do that is you're able to stomach some short-term declines, and you will likely be rewarded if you stay the course. Looking under the hood a little bit, another 5-year chart, growth stocks are what has really declined recently. So the things that did great the last few years are coming back down to earth, which is not to be unexpected. And we have more value stocks in our client accounts than the overall market, so that has helped a little bit from a performance standpoint. But this action of growth stocks converging a little bit in value to value stocks reminds me a lot of the tech bubble in the early 2000s, which a lot of us lived through. And so we've seen that before. Some examples of some year-to-date declines in some stocks is listed here. While Netflix is a great company and has a great streaming service, their share price likely just got too high over the last couple of years and has come down to more appropriate values today. Well, the stock market has declined recently. If we look at a common measure for how expensive the stock market is, called a price to earnings ratio, that tells us what we're paying for earnings in the market. That's actually come down to very normal levels. So while the stock market has come down, earnings have been relatively strong, and stocks are going from probably a little bit expensive to very fairly priced today. Some of the good news in the stock market is that earnings look relatively strong. The left-hand side, those blue bars are expectations for earnings the next few quarters. And the right-hand side is another way of showing that stocks have actually gotten cheaper despite earnings getting better. You think about all the things that are negative in the media headlines right now, it may be surprising that stocks aren't down more than 20%. One of the main problems we're dealing with are supply chain issues, and that is related to inflation. Another thing the stock market is pricing in is a midterm election year, which historically has not been good performing years for the stock market. However, the market tends to get back on track once we get through the election. One of the reasons midterm election years are typically lower from a return standpoint is that the political rhetoric on both sides of the aisle tends to get people nervous. And when people are nervous, they don't want to put money to work in the stock market. There is some good news if we look at history, though. After a midterm election, the stock market tends to do better than it does in other times. So if history is a guide, we could be in line for a post-election rebound. There's a saying on Wall Street that the stock market climbs a wall of worry. What that means is that there's a lot of things that are negative in the headlines and in reality. And as the economy deals with those and things get better, the stock market trends higher. An example would be inflation. If we get some better inflation numbers over the next couple months, the market would likely respond positively to that. If we get gas prices under control, that would also be good for the stock market. If supply chains are able to start to normalize, once again, the markets would like that. And get this midterm election behind us, that's another reason the market could trend higher. Back to buy low and sell high. Historically, when consumer sentiment is high, the forward-looking returns have actually been low. On the flip side, when consumer sentiment is low, like it is right now, forward-looking returns in the stock market have been much better. So what's the plan? We've been telling investors if you are adding to your investment accounts, you're at the phase of your life where you're not drawing off your portfolio, this is a great time to be buying low. We often joke that investments are one of the few things that people don't want to buy when they get cheaper. But right now, everything is much cheaper. And if you have a 5 or 10 or 20 year time horizon, you will likely be excited about the buys you're making while things are low. If you are in withdrawal mode in retirement, we have built portfolios to be durable for these very events. So stay the course, stick to your retirement spending plan that was crafted knowing that there's going to be ups and downs in the market. And if we do go lower in the stock market, we are pretty excited about making some opportunistic buys like we did back during COVID, and we also did during December of 2018 when the stock market went down. So stay tuned on that front. It looks like we're getting pretty close to that level in the market where we get excited about making buys. Of course, don't ever hesitate to reach out to us. We love hearing from clients, and we want to be a sounding board and a release valve if you're feeling stressed about your investments. Thank you.